So welcome. Thanks for joining us today. My name is Allison. I am the manager of on-site advisory here at KWB. I work with our clients to help them solve problems and make progress towards their goals. And I'm joined by Darren Buma, and I will let him introduce himself.
Yeah, thanks, Allison. So again, my name's Darren. I'm a partner with KWB, and for the last 20 years, I've been spending time working with entrepreneurs and trying to minimize their taxes, help them grow their businesses, and really make their lives better.
So this is just a quick run through of what we're going to cover today. We'll give you a quick introduction to KWB, who we are, what we do, for those of you that aren't familiar with us. We'll talk about integrated financial planning, what it is, what we mean when we say that, and what information we need to look at to consider when we're doing this financial planning. We'll also walk through a case study together to illustrate the concepts in a little more meaningful way. And we'll discuss the best timing and forms to pull income from a company into your personal name, various other tax planning concepts with examples, and overall wealth management through our sample couple's lifetime together. And then at the end, of course, we'll have lots of time for some questions and answers. So put your questions in the chat as we go, if you think of anything, and then Samantha will bring them back to us at the end. So KWB Accountants and too fast. KWB Accountants and Advisors has been operating in the Edmonton area for 28 years. We are really a tech-friendly firm, and we serve our clients. We use things like Zoom and technology like that to serve our clients wherever they are. So we work with clients not only in the Edmonton area, but across Canada. Our services include bookkeeping, financial statements, and tax preparation, and then, of course, integrated planning for the future. And our on-site advisory services, which is my department, those are our services focused around looking forward into the future and helping our clients move towards their goals. Our mission at KWB is to provide you with great advice that improves your business, simplifies your accounting experience, and helps you reach your goals. At KWB, we focus not just on your business, but we really take a more holistic approach by looking at both your business and personal worlds, what your lifestyle goals are, what your overall financial goals are, and any family dynamics that are going on within that. We want to help make life easier for you. We want to improve your finances overall and help you move towards your goals. And then we integrate this into everything that we do by always keeping that big picture in mind. So whether it's preparing your year-end and tax returns or working with you in a more proactive manner to look at strategic planning into the future, we're always considering your current circumstances, your short and long-term goals, and any opportunities that are available to you. So that's what we mean when we talk about integrated financial planning. It's built into everything that we do. So when we're doing that financial planning, there's a number of things that we may look at and consider. We may look at building out budgets or a savings plan for you. We always have tax minimization in mind. We're accountants, so that's always that's ingrained into us. We're looking at investment forms, so where those investments are best held, whether in your corporate world or in your personal world, and what types of things we would recommend investing in. We'll also consider insurance needs for both risk management and as an investment vehicle. We're always going to keep family situations in mind. So education, maybe you want to help your kids buy their first home one day, that kind of thing. And then, of course, retirement planning and estate planning come into play there as well. So this is our family that we're going to walk through together today, a case study centering around them. These are the Millers. Bob and Sue Miller are in their early 30s, and they have one daughter, Sally, who's a baby. Sue is an entrepreneur running a fairly new consulting business. Bob is an electrician and is employed with a salary. Talking to them about their goals. On the long term, they of course want to focus on building Sue's business, saving for Sally's education through an RESP, also planning for retirement in and around their mid-60s. On the short term, they want to pay down that mortgage on their home so that they can maybe one day move up into a bigger home. And they also want to focus on taking some family vacations each year. So Darren, what's the main thing that you think we should consider for Bob and Sue at this stage?
Thanks, Allison. So probably the most critical discussion that we're going to have at this point in time is how is Sue going to compensate herself out of the business? And with a lot of the conversations and the things we're going to talk about today, it really is critical that Sue understands how income in a corporation is taxed, because that really is the basis for all of the discussions that are going to go forward. So real quickly refresher for everybody here, active business income in a corporation in Alberta is taxed at 11% on the first $500,000 and 23% on any income annually over that $500,000 limit. Now, when we compare that to the personal tax rates in Alberta, which can get as high as 48%, sorry, and we'll look at some of the marginal rates a little bit later. We can see that there's a really significant tax deferral and an opportunity to save and preserve cash and reduce annual taxes by leaving money behind in the corporation. So we need to talk to Sue about how much money she's making, how much she needs to take out of the business in order to do the things that she needs to do personally, and how much potentially she can leave behind. So Allison, where are we at with that knowledge with Sue?
Yeah, so we had a chat with Bob and Sue about their current earnings. They indicated that they spend about 80% of their earnings right now on their living expenses, and they have about 20% left over to devote towards savings. But given that they want to start to pay down that mortgage and save for Sally's education through an RESP, we think they're going to need to pull most of their current earnings right now out of the company. Sue heard through the grapevine that dividends can be a really beneficial way to pull money out of the company because they have a lower tax rate. What are your thoughts on that, Darren?
Well, Sue's not incorrect on that, but there's, again, probably a bigger understanding that she needs to have. So with discussions or through discussions with her, we understand that there's about $80,000 worth of profit at the end of the day in the corporation that Sue can take out and pay to herself. So there's two options. Sue can either pay herself a salary, or Sue can pay herself dividends. So let's talk a little bit about the difference on those. If Sue draws an $80,000 salary out of the corporation, that would grind the net income in the corporation down to zero. So there would be no corporate income, no corporate taxes. All of the taxes on that salary would be paid personally. And that's reflected in the left-hand column that we see here, the sort of teal colored box, and we have approximately $17,000 worth of personal tax that would be owed on that $80,000 salary. Now, the alternative is the corporation keep that $80,000 as a profit and pay the 11% corporate income tax rate, which is about $8,800. And that's reflected on the right-hand column with the white box. So what Sue heard was, hey, if I take a dividend out of the corporation, I pay less personal tax on that than I would if it was a salary. And that is true. And what we see in that right-hand column is the teal box is the personal tax that she would pay on that dividend, where obviously that means less personal tax, but we have to take into account the fact that the corporate tax was also paid. So when we look at the two scenarios, they're somewhat similar and we're somewhat indifferent as to whether Sue would take salaries or a dividend. I mean, there is a $400 difference. The dividend route is slightly more expensive, but you know that that's only the tax analysis.
Are there any other factors that we might want to consider that's going to maybe tip Sue in one direction or another?
Well, for sure. So the as we'll see in the next slide, salaries, if a salary is paid, the corporation has a requirement to corporation and the employee has a requirement to pay CPP. So on that $80,000 salary, there's going to be about $7,500 for the CPP that needs to be paid. Now, that's not necessarily a terrible thing, because when Sue retires, she, you know, if she's been contributing to CPP every year, she'll receive some CPP benefits in her retirement. If she doesn't, then she won't. So Sue needs to make a little bit of a decision as to what her ability is going to be to personally save money. Is she better to pay CPP now, knowing she'll get something in the future, or should she keep that money and try and reinvest it herself? Another factor is RSP contribution rooms. If Sue's very positive about wanting to invest in RSPs and build that contribution room, then a salary does create that. When it comes to personal borrowing, and Bob and Sue have talked about, you know, they want to pay down the mortgage, they might want to buy a bigger house, so they're going to possibly want to qualify for a larger mortgage in the future. Having employment income on your personal tax return is much easier for the bank to understand than investment income, which is what a dividend would be. So the path of least resistance, and not that that can't be overcome, but the path of least resistance with the banks is to have salaries. And finally, on the salary side, it does require some additional administration, because there are typically regular payroll remittances that need to be made by the corporation. Now, on the dividend route, none of the above happen. So there's no CPP, no RSP room, very simple to administer. And all of the income taxes, that bar that we saw in the last slide, are due on the filing of Sue's personal income tax return.
Makes sense. So let's assume then that Sue will pay herself that annual salary of $80,000 because she wants to be able to easily qualify for a new mortgage when they're able to upgrade their home. And she acknowledges that it's a good idea to leave any additional income as the business grows inside the company to take advantage of that tax deferral that we talked about.
Great.
We're now going to jump ahead about 15 years down the road. Bob and Sue are now in their mid-40s. Sally's a teenager, which is super fun for them. Sue's business is successful and has grown significantly over the years. She's taken that advice and left as much as possible inside the company to take advantage of that tax deferral. And there's now an investment portfolio worth about $1 million within the company. Sally's bound for university. She's decided she wants to be a doctor, so they've got some significant education costs coming up in the near future. We have that discussion with them again to see what their goals are at this point in their life. So now on the long term, they're still talking about Bob retiring. He's thinking early 60s at this point. Sue wants to sell the business by around the same time, mid-60s. On the short term, of course, they want to save for Sally's university that's coming down the road. They want to travel more now that Sally's not a baby and not a little kid anymore. And they're looking at purchasing a vacation home in Mexico a few years down the road after Sally moves out, and thinking they're going to need about $90,000 for a down payment on that. So before we dive right into Bob and Sue's current situation, we need a quick crash course on marginal tax rates and how they work. So in Canada, our earnings are taxed at different rates depending on how much we earn. As your income increases, that doesn't mean that your rate is going to increase on all of your income. The margins stay the same for all of us. So when we look at the first tax bracket here, on your first just over 55,000, you're going to pay that 25% tax rate. On the next 55,000, you'll pay 30.5%. On the next chunk of 36.5-ish, you're going to pay 36% and so on until we get up to the highest tax bracket here, where everything over 355,000 is taxed at 48%. So if someone was earning an annual salary of 120,000, they would be right in here, just at the bottom of that third tax bracket. Excuse me. And if they earned anything over and above that salary, it would be taxed at that marginal rate of 36%. So we want to take advantage. We want to take these brackets into consideration when we're planning for Bob and Sue. We don't want anyone paying taxes at that 48% rate if we can keep them down in that 36% tax bracket. Looking at what each of them are earning personally now, we can see that Bob is near the bottom of that second tax bracket, and Sue has increased her salary over the years. She's now at $110,000 a year, and she's near the top of that second bracket. So just looking at this, I think it would be best if we could give Bob some additional income needed to get more funds out of the company for that vacation property down payment, because he'll pay 30.5%, where Sue will pay 36%. What do you think about that, Darren?
Well, that's a great discussion to have, and clients are always asking for, how do we lower our tax bill and how do we split income between the two of us? And effectively, there's two mechanisms again that this can be done, and one would be paying wages to a family member, and the other would be paying dividends. So let's talk a little bit about the consequences of either of those strategies. In the cases of wages are fine, but they need to be commensurate and reasonable for the amount of work that the person, the family member, is actually contributing to the business. So CRA would not be excited about Sue paying Bob a $30,000 or $40,000 salary for not doing anything, right? If they were to find out that that was happening, they would just end up denying the salary expense within the corporation, and it would end up getting kind of rather expensive from a tax perspective. Now, that being said, if Bob or Sally, for that matter, are actually doing something in the business and we can justify a wage, that may be an option. Now, we need to consider, though, when we do that, there might be a little bit of loss or leakage to CPP. So Bob's already working full time. He's already maximizing out his annual CPP contributions. So if Sue's company pays him a wage, not only does Sue's company have to pay the employer portion of CPP, the employee portion still needs to be remitted as well. Now, Bob will get that back when he files his personal tax returns. So there's no net cost to him. They're just out the cash for the time being. However, the employer portion does not get refunded back. And Bob's not going to get any additional retirement benefit during retirement for the fact that Sue's corporation contributed to the CPP program. So it really is a net loss, and these are some of the things we need to consider whether we want to go with salaries or not. Now, on the dividend side, this was something that was really common many years ago, and is probably still happening today with some accountants and advisors not necessarily being up to speed on all the rules. But back in 2018, the government introduced the tax on split income rules, which say that if the family member is not actively working in the business and they receive a dividend, it's going to get taxed at that highest possible personal tax rate. So in that case, if Bob took a dividend, Bob's going to be taxed at that effectively that 48% tax rate, when Sue could have taken that dividend and been in a lower bracket and it would have been cheaper. So we really want to avoid salaries going to Bob if he was a shareholder in the corporation. Now, there's exceptions to that. One of those is if the family member is working more than 20 hours per week in the business on a regular basis, then we can pay them dividends at their regular marginal rates. And then looking forward, there's some opportunities during retirement, because once you're over 65, these rules don't apply. So if Sally's company was able to accumulate a lot of wealth over the years, now in retirement, we can start pulling this money out between Bob and Sue. And Bob certainly could take some dividends that would definitely reduce their overall family tax rates.
So it sounds like we probably need to put the income into Sue's name to get that extra $90,000 out of the company that they're planning for. Is there anything else that we can do to minimize the taxes on that?
Well, there certainly is. So you've already talked about and explained the marginal tax rate. So if 3 years time they decide they want to move ahead with their vacation property and pull that $90,000 out, Sue's going to be looking at having to pay tax on all of that at one time, and that's going to move some of those dollars into the fourth and the fifth tax bracket. So it's going to attract more tax than if perhaps we did that on a slower basis over a period of time. So let's just take a flip to the next slide, and we can look at this scenario where now we talk to Sue and have her take $30,000 a dividend over the next 3 years. So that's going to accomplish her 90,000 3 years from now. But all of that money, all that extra money, the difference between the two horizontal lines, is now being taxed at that third tax bracket 3, rather than some of it in 4 and 5. And at the end of the day, there is a net tax savings to Sue.
Good to know. Of course, she's going to want to consider the time value of money here. If she thinks that she could keep that money in the company for that 3-year time and invest it and earn more than the $3,200 she would save by drawing it out over the 3 years, she might choose that. But it definitely looks like this is a concept to consider when we know that there's a big purchase coming down the road.
Well, and that's correct, Allison. Now, there are some other concerns about having growing investments in your corporation, and it's something you might want to explain now.
So the tax rates we talked about before with regards to the tax deferral available when you leave your earnings inside the company was the rate on active business income. So active business income is earnings generated from the company's business operations, while passive business income is earnings generated from the company's investments and properties. Sue now has that investment portfolio in the company that's also generating some of this passive business income. So Darren, what do we need to know about how passive income is taxed differently within a corporation?
Yeah, thanks, Allison. And this is a really important one. So the federal government is not excited about the idea of Sue having a successful business, getting access to these lower corporate tax rates, either the 11% or the 23%. The intention with that is that surplus that's left, or that money that's left, that tax deferral, Sue would be using that to invest in her business. So growing her business, hiring more employees, buying more inventory, whatever the case might be. They're not excited about Sue using that tax break that the active business has to grow an investment portfolio. And similar to that, they also don't want the income off of an investment portfolio to also get that beneficial tax rate, because they perceive that that's not fair to all other Canadians and all the taxpayers in general. So the passive income in a corporation will initially be taxed at just about 47%, which sounds high and a little bit punitive. But it's important to understand that there's two components to that. The first component is the base tax, which is 18%. So that's going to get paid no matter what. And then there's a refundable portion, which is almost 29%, that is available to the corporation if the corporation pays enough dividends out to the shareholders. So the idea here is we have investment income earned in the company. We're going to pay some corporate tax, but whatever's left, generally speaking, we're going to pay as a dividend out to Sue. And Sue's going to have to report that on her personal tax return, and she's going to have to pay some tax there. All right. But if she does that, the corporation is only going to have to pay 18% on that income, which in itself is more attractive than the 47%. So let's take a look at a visualization on the next slide, because I think it'll help explain this a little bit better. So Sue has, she has $1 million in her corporation. It had a good year. It had a 10% return. So there's $100,000 worth of passive income in her corporation. The left-hand column shows us what happens if we don't do anything from a tax planning perspective. Sue doesn't take any dividends. So the white box at the bottom is the 18% tax that we talked about, and the gray box on the top of the left shows the refundable tax that would have to be paid in the corporation. So that would be the annual tax bill, and we could just leave it there. However, if we paid Sue about an $80,000 dividend, which would be sort of the net difference between the 100 minus the corporate tax, we can see that the sort of teal box in the right-hand column represents the personal tax that she would pay. So by paying that, and of course the refundable tax isn't paid in the corporation because we paid the dividend to Sue. So what happens then is overall on an annual basis, the overall tax is lower in that scenario because Sue's personal tax is actually less than what the refundable tax would be in the corporation.
That makes sense. We also need to consider the small business deduction here. So this is a refresher of what we looked at earlier. Darren told us that the tax rates on active business income is 11% up to $500,000 and 23% over that $500,000 threshold. Darren, what effect does passive income earned in the company have on that 500,000 small business deduction threshold?
Yeah, great question, Allison. So again, the corporation, or sorry, the federal government is, happy to provide 11% tax rate to a corporation if it's to allow it to use that extra capital to reinvest in its business. If they are reinvesting this in an investment portfolio, CRA wants to sort of further incent the company not to do that. And one of the consequences is as investment income on an annual basis grows in the corporation, the company loses its access to the small business deduction. So what we see here in the chart is a good visual representation. So as your passive income goes from $0 to $50,000 in a year, there's no effect. That first $500,000 is still taxed at 11%. But as your investment income grows from 50,000 all the way up to 150,000, we can see that the amount of earnings that's available to be taxed at that 11% rate is reduced down to zero. So if Sue ends up, sort of tripling the portfolio in her company, and she's or not tripling, more than she's at 100,000, so she doesn't have to do too much more, and she wouldn't have any access to the small business deduction. Now, this means then that all of her business income is going to be taxed at 23% rather than 11%. And that's obviously a little bit more expensive and something we would want to try and avoid.
So does that mean that she would then pay the same rate on dividends that she pulls out, effectively paying 12% more on that money in the end?
Well, that's another good question, Allison. And that was a big problem prior to 2007, and something that a lot of accountants would have to plan around, because if you did pay the higher tax on the corporation, the dividends, a dividend was a dividend, and there was only one kind of dividend and one kind of tax rate. After 2007, the government did realize there was this inequity in the system, and they created two classes of dividends. And we have the non-eligible dividends that we see on the left, and we have eligible dividends that we see on the right. So what's the difference? So if a corporation pays corporate income tax at 11%, whatever's remaining from that surplus from that would get paid out. When it's paid out as a dividend, gets paid out as a non-eligible dividend, and the personal tax rate on that is a little bit higher than the alternative. If the corporation is forced or required to pay 23% tax on its income, that remaining surplus can be paid out through what's called an eligible dividend to the shareholders, and the shareholders have a lower tax rate on that type of dividend. So what we can see from the chart here is on a flow-through basis, again, we're fairly similar. so the income that Sue's paying 11% on, she's going to pay more personal tax on the 23% corporate income. She pays less. So the real difference here is the deferral that's available if, based on how long Sue can leave the money in the company and not pay it out. But she's not being punished for the fact that the corporation had to pay 23%.
That's good news. Is there anything else that we need to think about for Sue and Bob right now?
Well, there's lots of conversations to have with Sue and Bob, and we've talked strictly about tax and compensation so far. But there's a number of things that they want to be thinking about, and particularly on the risk management side and on their sort of estate planning side. Sue's biggest asset right now is not just her business, but her ability to work in the business and her ability to earn an income, right? So they need to think hard about what would happen if, Sue was in a position for medical reasons where she couldn't work for a period of time. And that's where we wanted to have them take a really good look at some income replacement insurance, as you would call it, disability insurance, to protect, not only the business, but the family from Sue, not being able to work. We also want to think about critical illness insurance. Now, critical illness is an interesting one because it doesn't kick in, whether somebody can work or not work, but it's a policy where if you are diagnosed with a certain list of illnesses, which include things like cancer, heart and stroke, multiple sclerosis, all sorts of different things, it'll pay out as a lump sum to the policyholder. And the intention with this is, if Sue's rolling through life and everything's good, and then something happens, and we're in Breast Cancer Awareness Month, so Sue finds out that this is something that happens to her, she needs to take a little bit of time away from the business. She needs to be able to focus on herself, her health, cure herself, get better. The lump sum payment from the critical illness policy can really make a big difference to improve her, her mental health and their ability to work through this. There's some really interesting tax components to this as well, and we won't get into that today. But it's possible that if somebody buys one of these policies and never uses it, that they can actually get all their policy premiums back in the future, right? So it's an interesting, it's almost a win-win scenario where, unfortunately, if something happens to you, you do get diagnosed, you get the payout. If you're lucky enough that you don't get diagnosed, you still get your money back. And we're really excited about those and like to talk to people about that. And then the last piece of insurance, of course, is life insurance. And life insurance, traditionally is a risk management tool. It's like something happens to Sue, and she passes away. There's enough money to help the estate with, want to pay off their mortgage. You want to make sure that Bob and Sally have enough money to finish their education and live on and retire comfortably, and the business can be sold and all of that type of thing. We're going to talk a little bit more about life insurance a little bit later in the presentation, because it can go beyond just dealing with today's risks that we're trying to mitigate, but really be an effective investment tool in the grand scheme when we start talking about estates. A little bit more on the legal side, and we'll go through these quickly, but something that a lot of people overlook, and that's, do you have your wills in place? Is everything, is it clear what's going to happen if something unexpectedly happens to Bob or Sue, and what's going to happen with the corporation? Who's going to be the one, making decisions over things? Not having a will in place can really make it difficult to administer in the state, because now you're dealing with government bureaucracies and the courts, and it's just not fair to it's really not fair to the survivors to not have your will and your plan put in place. But beyond the will, we want to think about the power of attorney. So, something happens to Sue, she doesn't have capacity to make financial decisions for herself. Is there, who's going to step in and be able to, take over and help run the business, deal with all the personal affairs personal and financial affairs. Again, not having that in place and not having that clear can really lock things up within the legal process for the family for some period of time. And then the last piece is personal directives. And the difference here is a personal directive deals with your healthcare decisions, right? So, something happens to Sue, she may not be, she's in a coma in a hospital. So the power of attorney kicks in. So Bob has that. He can make all sorts of decisions about the business and banking, but that doesn't give him authority to work with the medical professionals to make decisions about Sue's care. And that's, this is something that has nothing to do with taxation, but it has everything to do with trying to make everybody's life a little bit easier in those situations. So when when we're looking at these, we're looking at all three of these together and making sure that they actually all work together and that everything's current and in place.
Good to know. So now we're going to jump ahead again into the future, another decade down the road. Bob and Sue are now in their mid-50s. Sally's in her mid-20s. Bob is getting closer to retirement, and Sue is starting to seriously think about selling her business so that she can retire with Bob. The investment portfolio inside the company has now grown to $2.5 million, and Sally is in med school studying hard to become a doctor. We revisit goals with them again at this point. And now on the long term, they're really interested in traveling some more. They want to start to think about leaving an inheritance for Sally one day. On the short term, they're thinking about Bob's retirement soon. Sue wants to sell her business within 5 years. She also wants to start to reduce her time in the business in the meantime. And they want to continue to help support Sally in her education and help her buy her first home. So Darren, what does Sue need to think about specifically right now when it comes to selling her business?
Yeah, thanks, Allison. So really two things. I mean, one is the taxation around the sale of the business and what can we do to plan and minimize the overall tax. And then the other one is how do we optimize and maximizing her sale value, or we call it her exit value. If she can sell the business for $4 or $5 million, she's certainly going to be better off than if she sells it for $2 million, right? So those are the two big areas.
Okay, so let's start with the tax side of things. What are the things that we need to be aware of in order to minimize the income tax on a sale of a business?
Okay, so there's really, let's start with talking about what could be sold or how you might sell your business. And there's really two options. The two options are an asset sale or a share sale. So an asset sale is where the buyer is only buying the specific assets out of the corporation that it's interested in. So that might be the name of the business, that might be the client list, the goodwill, it might be patents and intellectual property, could be, equipment, inventory, things like that. All right. When that happens, there will be any gain on those assets will be a capital gain in the corporation, and all the tax will be within Sally's corporation. All right. If it's a share sale, this is where the buyer is buying Sue's corporation. So the buyer is getting everything. The buyer is getting the assets and the liabilities. Sometimes this can be a little scary for the buyer because they don't know what skeletons are in the closet or what sort of inherent liabilities. I mean, maybe Sue gave some bad advice, a year ago that, somebody's planning a lawsuit. If whoever buys that business, they're going to be stuck with the consequences of dealing with and perhaps paying out against that liability. So that's maybe the downside, but the upside to Sue is the capital gain would be reported personally and not in the corporation. And if we plan things out properly, each individual, so Sue in this case, could have a $1.25 million capital gain on the sale of business shares and effectively not have to pay any tax on that. So that in itself is a pretty big key consideration. And so Sue wants to be doing everything she can to prepare herself and her corporation for a share sale.
So can you tell us a bit more about that? What are the things that we need to consider to plan for a share sale and put her in the best position for that?
Yeah, well, I think so. A couple of things, and one is, let's remember that Sue's selling everything that's in the corporation. So we want to, make sure that we just have the assets in there that she wants to sell. The other thing is we want to make sure that her shares qualify for this lifetime capital gains exemption. And CRA's, the Canada Revenue Agency's, happy to give this tax break to somebody if they're selling a corporation that is solely and primarily all business assets. So there's a couple tests that we need to keep in mind. And in the 2 years leading up to the sale, more than half of the assets need to be active business assets. So they can't be cash, stocks, bonds, and all sorts of other things that are sort of redundant to operating the business. And at the time of the sale, 90% of the assets need to be active business assets. So we have to look at what's in Sue's corporation and say, okay, are we going, in the 2 years prior to the sale, we got to make sure that we're meeting that 50% test all the time, not just at the year ends. And at the time of the sale, we have to meet that 90%. So let's take a look and see what's there now, and we can talk about what you might need to do.
Yeah, it sounds like that portfolio that's inside the company might be a little problematic. So when we look at the asset makeup of Sue's company, she believes her business is worth about $2 million today. And it might be worth 4 million in the future. So the portfolio portion that's held in her company is valued right now at about 2.5 million. So when we look at that on a percentage basis, about 55% of her assets are those passive assets, and only 44% are actively being used in running the business. So it looks like she's going to fail that 50% test at this time. Is there any?
Oh, sorry, just go ahead.
Sorry, go ahead.
Well, I was just going to say, so that here, here's a great example. If Sue was going to do an asset sale, then she's selling everything in the right-hand box, the active box, and it really isn't an issue. But if she was doing a share sale, not only do we have this problem today where we're not meeting that 50% test, but Sue doesn't want to sell her $2.5 million worth of investments. That's her retirement money, so she's not going to sell that for cash. So this is how we want to look at the share sale. Is a great visualization of the share sale, saying, hey, everything that's in there is going to go. And is that what we want?
So it sounds like we want to get that portfolio out of the company either way. We want to get it out because she doesn't want to sell it and let it go with the company. And we want to get it out because it's causing her to fail that 50% test right now. How can we do that, Darren?
Yeah, no, you're absolutely right, Allison. And this is where we would introduce the concept of a holding company. And there's a bunch of tax rules that, and some that allow us to do a reorganization to just accomplish that, right? We can separate the investment assets from the business assets. And Sue now has two companies. There's a variety of ways that this can be structured. You can have the holding company owning some of the consulting company. We won't get into all the complexities and opportunities today, but this is something that Sue needs to talk to us about, right? And what might make the most sense.
Awesome. So yeah, there would be some more administrative costs in running two companies, but it certainly would be worth it to potentially save $380,000 in taxes when she sells those shares. So is there anything else that we can do to take advantage possibly of Bob or even Sally's lifetime capital gains exemption?
Well, you're right. So as we're going through this reorganization process, we want to be forward looking and saying, okay, if this business is going to be selling for $4 or $5 million, Sue's $1.25 million exemption is great, but the rest will be taxable. How, could we possibly use Bob's or Sally's? Like Bob's an employee, he doesn't own a business, he's probably never going to use his exemption. Sally's planning on going into medicine, likely won't be in a position where she'll be selling a corporation. So it'd be great if we could take advantage of those. So one option is now we add Bob and Sally as shareholders in the corporation, right? So when it sells, Now we've got 3 times the $1.25 million exemption.
That sounds great. Sally's still a fairly young adult, though. Sometimes people don't feel comfortable adding their adult children in as owners of their companies, just because things could be a little bit unknown down the road and what that adult child is going to do and where they're going to be in life. Is there anything that can be done to protect against those types of uncertainties?
Well, for sure, right? And this is where, if we want to have more flexibility in the future, we may want to add in something like a family trust, and we call these a discretionary family trust. So right now, with the structure that we see here, Bob, Sue, and Sally all potentially could participate in the sale of the business, but that decision doesn't need to be made today. That decision then can be made at the time of the sale, right? So, things might change in Sally's life that would mean it's not appropriate for her to participate in the sale. Let's say Sally, is doing research and she moves out of the country, let's say to the United States, and is working there as a U.S. Tax resident. She would be taxed on the sale of the business. The capital gains exemption doesn't exist, so we wouldn't be saving anything by giving her the money, and in fact, it would just overcomplicate her tax filings down there. Perhaps she's in a relationship at this point that's not working out, and there's some concerns over, the value of money that her and her ex-partner have and how that should be distributed. If she's got shares in this corporation, does that ex-partner have the right to some of that money? So there's a whole bunch of reasons why it might make sense to layer on a family trust. But as you alluded to before, Allison, it does increase the administrative costs annually for the family. But the ultimate benefit is, again, 3 times the exemption, which could easily be over $1.1 million of tax savings on the sale.
That's pretty powerful. So tax. Go ahead.
I'm sorry, Allison. I was just going to say, so we talked a lot about tax, but what about maximizing the value of our business? What does Sue need to be thinking about there?
Yeah, so selling a business is a huge financial transaction, probably the biggest transaction that Sue is ever going to have in her life. So it's really important to plan ahead a bit there and kind of get the house in order, so to speak, ahead of time. One of the most important things for Sue to consider now with regards to selling her business is how well that business operates without her. So can the business even operate without her? How well will it operate without her? Is the branding of her business really built around her? Is she really the face and the voice of the business? It's much easier to sell a business that will operate independently without that entrepreneur present anymore. It's one less thing the new owners will have to worry about in the transition of taking over. So coincidentally, she also said when we talked about her goals, that she would like to start reducing her time in the business. So now is a really good time to start thinking about that, building the processes that are necessary for the business to operate without her, and starting to kind of step back and separate herself from the business a little bit and make sure that things run independently of her. Also, it's a good time to start to think about documentation, getting all of the business contracts well documented and in place, things like property leases, customer agreements, employee agreements, making sure that that's all really well documented. That would also include things like documenting policies and procedures within the business, again, focused around making sure the business is operating well and everything's in place to support that. Now is also the time to start to think about any intellectual property the company might have. So any patents, procedures, trademarks are in place. The corporate name and brand is well protected, and any processes or products that the company has developed are protected with those patents and trademarks. Finally, she'll want to make sure that all of the corporate records for the company are in great shape and in place. So is the corporate minute book up to date and complete? Are all the taxes in the past filed and up to date? Are their bookkeeping records in really great shape? Easy for somebody else to step in and take over and understand well. She also might want to consider, if she has not already, stepping her year-end engagement up to a review engagement. That will provide any potential buyers with just a higher level of trust in those statements going forward.
Well, those are great points, Allison. And, again, when we talked about a share sale, the buyer is buying everything, right? So let's make sure that we have our house in order, because there's going to be a fairly significant due diligence process that goes on. And the last thing you want is to have some, again, skeletons in the closet or things that end up scaring the buyer, right? So
Or even questions you can't answer.
Your advice is great.
So with the sale of her business in the works, it's looking like that wealth that's accumulated in Sue's holding company probably won't need to be touched on their retirement. On death, assuming those investments have grown in value to about $3 million by then, taxes on that could be as much as 1.26 million at that high rate of 42%. Is there anything that we can do now to minimize this tax?
Well, there certainly is, Allison, and there's a couple of things, and one is, we talked about the marginal tax rates earlier, so perhaps we start to pay some of that income out to Bob and Sue in retirement by the form of dividends and the like. But they have enough through the sale of the business. It would seem that they're going to have enough personal cash to meet all of their retirement plans, travel, living, those types of things. So the money that's in the holdco very much is estate money, likely that's going to be left for Sally or perhaps even some charitable giving purposes. So we want to look at how do we preserve that, and they say there's three places that your money can go when you die. It can either it can either go to your family, it can go to charities, or it can go to the tax department. And you can usually pick two of those, but you can't, so we want to do what we can to avoid funds going to the tax department, right? So we talked about life insurance earlier, and this is where I wanted to loop back on this concept is, life insurance at one stage of your life is very much a risk management tool. But now when we're talking about estates, it can really be a wealth management tool. And so we can dovetail the two together. And so, if we imagine now that half of Sue's investment portfolio had been invested in and through a whole life insurance product, that $1.5 million is still invested and it's earning some money. It might be invested a little bit more like pension funds. It's not going to be invested in risky stocks on foreign exchanges or anything like that, but it's going to get a fairly decent return. But it also grows tax-free within the insurance product. So now we've got a little bit of I almost call it like a corporate RSP happening, right? And then ultimately on death, when we're looking at it, that the entire amount gets paid out to the corporation through what's called the capital dividend account. And I won't get into all the details, but it allows us to pay all that money out to the shareholders or the estate tax-free. Right. So instead of that 1.5 million being taxed at 42%, it's all going out to the estate tax-free. That's a tax savings of over $600,000. So when you think about it, again, now this is a really powerful wealth management and investment tool in our estate planning.
Amazing. So this concludes our journey with Bob and Sue today. Just in summary of what we talked about, we really helped Bob and Sue to reach their lifestyle goals over the years by minimizing their taxes each year through both tax deferral and tax bracket planning. We helped them mitigate risks throughout the years with insurance coverage and discussions about estate planning. We helped Sue prepare for the sale of her business by getting her business into top shape and doing that structural planning in order to minimize the tax on that big transaction when she sells. And we also help them with their estate planning and minimizing the taxes that occur on their wealth at death. Overall, throughout the years, we really hope we've helped, provide them with security and peace of mind, knowing that we've been with them every step along the way of their journey. Anything to add there, Darren?
I think that's about it. You summarized it really well. I mean, it's been a great journey working with Bob and Sue over the years, and giving them the peace of mind that they're looking for, that their plan is going to work, and that they're going to be successful meeting their living and retirement goals. So no, great comments today, and I'd like to thank everybody for coming, and of course, if there's any questions that anybody has. We've got a couple minutes left here. Anyways, feel free to ask them, either unmute yourself and ask directly, or throw it in the chat.